Welcome to the deep dive. We cut through all the noise of the financial markets. We take stacks of sources, research, regulatory filings, and we turn them into immediate knowledge for you. Today, we're unpacking one of the most compelling signals you can find. It's also sometimes one of the most contradictory signals, a massive, timely insider stock purchase. Our subject is SentinelOne. They're a major cybersecurity firm. You've probably heard of them. They trade on the public markets. And the transaction we've been analyzing, it happened against this backdrop of, frankly, deep market skepticism and some pretty negative returns. And this isn't just about a stock trade. It's really about a decoding conviction. Our mission here is to dissect the mechanics of this insider buy. We want to understand why someone with, intimate knowledge of SentinelOne would commit so much capital when all the external signs looked pretty dismal. We're asking what this person believes they know about the company's future that the rest of the market seems to be overlooking right now. Okay, let's unpack this unusual vote of confidence.
It really is a classic dilemma for the market, isn't it? You have this really strong internal belief on one hand, and then this weak external performance on the other.
Exactly.
And when you see an insider allocate nearly $600,000 to a stock that has lost, a third of its value in the last year, you have to lean in. You have to analyze the rationale. This kind of aggressive accumulation is, it's rare. And it's highly suggestive.
Okay, so let's start with the hard data. I think we need names, dates, and dollars. Who exactly made this powerful statement, and what was the scale we're talking about here?
So the individual in question is Mark S. Peak. He's a member of SentinelOne's board of directors.
A board member, okay.
The transaction was executed on December 16th, 2025, and it was structured as an open market buy of, get this, 40,000 shares.
40,000 shares, that's a considerable position.
Yeah.
What did that cost him based on the SEC filings you looked at?
Well, the weighted average purchase price came in at $14.89 per share. Oh. That means the total capital deployed in this single transaction was about $595,600, just shy of $600,000
Wow.
invested in one day.
Nearly $600,000. I mean, that is a significant commitment for anyone, even a corporate director. But what really makes this transaction stand out is the financial environment around the company at that time. Our sources confirm that SentinelOne's one-year total return, leading right into December 16th, was a negative 34.33%. He was buying deep into that market weakness.
And what's fascinating here is the context of his own trading history. This 40,000 share purchase isn't just large in a vacuum. It represents the largest single transaction of SentinelOne stock Mark Peak has ever executed on record.
His largest ever.
Ever. And when you see someone increase their exposure so drastically, especially when you don't see any big historical sell events, it signals maximum conviction.
And the timing feels almost predatory, in the best sense of the word.
Right.
He makes this huge purchase at $14.89 on December 16th. Just days later, December 18th, the stock hits its 52-week low of $14.43. He's essentially positioning himself right at the bottom.
That kind of opportunistic timing is almost never accidental. It suggests he had a very specific valuation target in his mind, and he executed the moment the stock price dipped into that range.
It's an explicit move.
It's an explicit attempt to capitalize on all that external pessimism.
So let's talk about the structure for a second. He bought the shares through his trust, right? This purchase significantly increased his indirect holdings through something called the Omega Living Trust to 120,000 shares.
That's right.
Can you clarify for the listener, what does putting shares into a living trust rather than just holding them directly? What does that tell us about his strategy or his, time horizon?
That is a crucial distinction. It really is. When a corporate director buys stock directly, it's often seen as a personal investment. But when they significantly increase holdings within a trust, like the Omega Living Trust, it typically signifies a much longer-term capital allocation strategy.
Longer term?
Much longer. Trusts are often used for things like estate planning, multi-generational wealth transfer. It means these shares are likely intended to be held for years, if not decades.
Okay, so this isn't a quick flip.
No, not at all. It dramatically strengthens the signal. This is a profound commitment to the company's long-term value.
So the long-term capital bet executed aggressively during a period of short-term market panic.
Okay.
After this transaction, he now holds, 43,501 shares directly, 120,000 indirectly through the trust.
And don't forget the kids' trusts. There are additional shares spread across 4 children's trusts as well, about 5,500 shares in each of those.
The total commitment is just.
Yeah.
It's truly substantial.
Absolutely. The number of shares he holds across all these vehicles, it just demonstrates that his economic alignment with SentinelOne's success is now deeper than it has ever been.
Okay, so we've established the scale and the sincerity of his bet. Now, if we look at what he's betting on, what exactly is SentinelOne bringing to the table that warrants this kind of confidence? For those who aren't familiar with the highly specialized cybersecurity world, can you give us the company profile?
Sure. SentinelOne is a pure-play technology company. They operate specifically within the cybersecurity and software infrastructure segment, and they're really focused on addressing the modern complexity of cyber threats.
And their core offering is built around AI, right?
Exactly. Their flagship product is the Singularity XDR platform. Now, let's just pause on that XDR acronym for a moment because it's really critical to their whole value proposition.
Okay, XDR. Let's unpack extended. What does that mean in practical terms, and how does that move the needle beyond a standard, say, endpoint detection tool that we might be more familiar with?
It's a great question. A standard, legacy security product might just monitor a single device, an endpoint like your laptop, and look for threats there.
Right, one device at a time.
XDR is the evolution of that. It's designed to unify and correlate data across the entire technology ecosystem. We're talking endpoints, cloud workloads, identity systems, networks, even email.
So it's not just a collection of siloed products, it's more like one brain observing the whole system.
Precisely. The extended part means it has the visibility to detect a threat that maybe starts on one platform, say a phishing attempt via email, and then it can automatically track its movement sideways through the network and up into the cloud.
I see.
And the key differentiator for SentinelOne is that this whole platform is heavily powered by artificial intelligence. It provides autonomous threat prevention, detection, and response.
And that autonomous response, that's the real promise, isn't it?
It is.
It's designed to automatically neutralize complex threats without needing a human analyst to step in, which is a massive selling point, I'd imagine, given the sheer volume and speed of modern attacks.
It's a very powerful value proposition. They're targeting large enterprises, organizations all over the world, domestically, internationally, that are just overwhelmed by the scale of the threat landscape.
And they're trying to solve that.
Their unified AI-driven platform promises rapid threat mitigation. They're aiming to replace these complex, fragmented security stacks with one scalable solution.
So it sounds like they're tackling the competitive space head-on by betting on AI superiority and platform consolidation. But yeah, that brings us right back to the central conflict here. If the technology is that compelling and an insider is buying this aggressively, why was the stock down so sharply? Why the negative 34% return?
This is where we transition from the exciting technology story to the cold reality of Wall Street expectations.
Right.
The market sentiment was bearish, primarily because of two things: profitability and guidance. SentinelOne is spending an enormous amount of money to achieve that growth and build that durable AI advantage.
Let's put some numbers on that enormous amount. What were the headline financial metrics around December 16th, 2025, when he bought?
Well, despite a pretty healthy market cap of about $5.01 billion, their financial performance showed a colossal net loss over the trailing 12 months, the TTM. It stood at negative $411.29 million.
Over $400 million in losses. That is the number that scares the traditional investor away. And, it's understandable. Where is that cash burn going? It's not just vanishing.
No, it's not disappearing. It's being invested aggressively. If you dig into their earnings reports, a significant portion of that loss is attributable to two strategic areas. First, massive R&D spending to maintain that AI superiority.
Okay, that makes sense.
And second, an extremely high sales and marketing burn, S&M FIFO.
So they are spending heavily to win the technological arms race, and they're spending heavily to land those crucial large enterprise customers.
Exactly right. They're in a classic land and expand competitive strategy. They are willing to operate at a significant loss to rapidly expand their market share. SentinelOne is trying to build a moat to make their XDR platform indispensable to large clients before their competitors can catch up on the AI front.
And that $411 million loss is the price of that strategy.
It's the price of aggressive market capture and, they hope, future defensibility.
And this strategic loss was then compounded by what was perceived as a disappointment in their forward outlook.
Correct. When they announced their fiscal Q4 guidance, Wall Street analysts were just expecting higher numbers. The company forecast Q4 sales of about $271 million. Now, that's a solid 20% year-over-year increase.
20% is not bad.
It's not bad at all, but the street had already priced in a more optimistic scenario, and when the company missed those, inflated expectations, the stock was punished severely.
So the market took the large, persistent loss, combined it with that disappointing forward guidance, and just decided to sell off, pushing the stock down toward its 52-week low. That is the bearish signal, and it's a powerful one. But here's where it gets really compelling. If we only focus on the loss, we completely miss the bullish signal that convinced Mark Peek to commit nearly $600,000. And that signal is pure, unadulterated growth.
The sales pipeline is clearly strong. SentinelOne's revenue has grown consistently, quarter after quarter over the past year. In that same fiscal third quarter, where they reported that $60.3 million net loss, they also reported sales of $258.9 million.
And that $258.9 million, that represented a strong 23% year-over-year sales growth. That percentage is key because it suggests the company is successfully executing its market capture strategy. They are winning deals.
23% growth in a challenging and frankly very competitive market like cybersecurity. That's not trivial. This insider purchase is a direct affirmation that they view this revenue trajectory as evidence of future success. He believes the current stock price severely undervalues the speed at which they are acquiring customers.
And it wasn't just the price in absolute dollars that signaled value, it was a valuation metric, price to sales, or the PS ratio. Can you explain why that ratio was such a compelling, bullish signal at the time of the purchase?
Sure. The PS ratio, it measures a company's market cap relative to its total revenue. It's often used to value these high-growth companies that are not yet profitable.
Because they don't have earnings to measure against.
Exactly. So when Mr. Peek bought, the stock was near its 52-week low, and as a result, its PS ratio was also near the lowest point it had reached all year.
So we're not just talking about a cheap stock price. We're talking about a cheap valuation relative to the revenue it was currently generating.
That's it, exactly. For an insider, this was an opportunity to acquire high growth potential. That 23% year-over-year revenue expansion at a discounted valuation compared to SentinelOne's own recent trading history. If you believe that growth rate is sustainable, then the low PS ratio makes it look profoundly undervalued.
Okay, so now we're connecting these two seemingly contradictory ideas.
Yeah.
The massive loss versus the massive revenue growth. If we connect this to the bigger picture of the software industry, we can see the complete strategic narrative taking shape.
Yes, if we connect this to the bigger picture, what we're seeing is the classic Silicon Valley playbook in action. Many technology firms, particularly those in these high-potential infrastructure markets like AI-driven cybersecurity, they operate this way. Their strategy is dominate the market first, achieve scale, and only then do you optimize for profit.
Essentially, they are betting that the fixed costs of R&D, developing the Singularity XDR platform, will eventually be spread out over a much, much larger customer base, making the current high sales and marketing spend worthwhile in the long run.
That is the bet. They are prioritizing market dominance and customer acquisition over immediate profitability. The insider buy, particularly the structured, long-term nature of that trust purchase, it signals a firm internal belief that this high-burn, high-growth strategy will eventually lead to an inflection point.
An inflection point where profits finally materialize.
And the stock re-rates dramatically higher. That's the hope.
It takes a certain level of conviction, or maybe stubbornness, to sign off on a $600,000 purchase when the stock is making fresh lows just 48 hours later.
It takes internal data. The outside world sees the loss and the guidance disappointment. The insider sees the customer win rates, the product roadmap, the competitive threat profile, and they make a decision based on that intimate proprietary knowledge.
So this is the validation.
This transaction is the strongest possible validation of SentinelOne's long-term business strategy.
So what does this specific deep dive mean for you, the learner, listening right now? We've dissected a massive opportunistic accumulation by a company director. An insider buy of this scale, executed so aggressively near a 52-week low, it just signals immense internal confidence. The board member is effectively saying that the market's focus on short-term profitability and disappointing guidance is a mistake.
I think the summary is clear. SentinelOne is experiencing powerful revenue expansion. That 23% year-over-year growth is strong, but they are incurring massive strategic unprofitability to acquire that market share quickly.
Right.
And this conflict has temporarily depressed the stock price, making it appear cheap on a price-to-sales basis, which is what prompted the insider to invest so heavily. It's a conviction that the current growth trajectory is the ultimate predictor of future value.
So the outside investor is selling based on the rearview mirror, the losses, and the insider is buying based on the windshield, the product roadmap, and the customer traction.
And that brings us to the final provocative thought that we encourage you to mull over. Since his entire investment is premised on the belief that market share expansion will inevitably transition into profitability, the critical question for an outside investor becomes, what is the risk-adjusted timeline? How long can SentinelOne continue this high-spend market capture strategy to build its competitive moat? And, how likely is it that the competitive landscape, we're talking names like CrowdStrike or Microsoft shifts or intensifies before SentinelOne hits that crucial inflection point?
That point where growth finally materializes into consistent, sustainable profit.
That's the multi-million-dollar question.
SentinelOne is betting on AI-driven growth. Mark Peak is betting nearly $600,000 on SentinelOne. That's the deep dive for today. We'll catch you next time.